In this section, we are going to talk about some of the most important things to take care of while doing equity valuations. These things are not any techniques or anything conceptual, but more behavioral issues or a few things that we probably need to keep in mind while making a good equity valuation model, right? So let's try and understand what these things are. While doing valuations, a few things that we as analysts should be keeping in mind are uncertainty that comes with the valuation process, complexity, which is how complex the model should be, and biases, which is what kind of biases exist while we are building a valuation model, right? Now, so we'll take these three things one by one and try and gauge as to what is the impact of these on a broader valuation process, and how do we kind of deal with these issues. Now, let's start with uncertainty. So, unlike fixed income valuations, where we knew that there is a fixed cash flow that is there and hence there is a fixed income proportion that comes there, equity valuations don't have fixed cash flows, and hence there is a lot of uncertainty in the cash flow projections, right? So effectively, both in terms of if we are using CF1, CF2, CF3, there is a fair bit of uncertainty in the cash flows itself when we are doing a DCF, right? And so on and so forth. There is also an issue that cash flow projections probably go till infinity, and hence we're not sure of what happens beyond a particular point of time. Having said that, what we should remember is that an analyst should welcome uncertainty, right? Why? Is because if there is no uncertainty, everything is clearly defined and fixed, then in fixed income valuations, your returns are low and kind of fixed. You know what is the money you're going to make. If you're going to make 110 next year and you're putting in 100 today, that's given to you, right? And nothing in this equation changes. But in equities, you don't know this 110. And so, if the uncertainty is higher, your expected payoff from that particular valuation or from that particular security should also be higher, right? So, higher the uncertainty associated with a set of cash flows, higher the chances of making above normal returns from it. Correct? So it's important to understand that unlike fixed income valuations, uncertainty is actually your friend. Right? Why is it your friend? Is because it gives you a chance to make above normal returns. Otherwise, you will never make above normal returns. You will make whatever is the market is offering and whatever is already defined for you. The only way you can make more money than someone else in this era of information is if there is a lot of uncertainty and you are able to deal with it better than someone else, right? And that is the role uncertainty plays in equity valuation. Always remember that it is a welcome step. Sometimes we end up feeling that we don't have enough information about a particular company, so how do we go and build about a model? Remember that the payoff in this case is going to be the highest. If you are the one who can make that model, your model will be a significant enhancement over anyone else who's in the market but is uncertain about it. So to deal with uncertainty, it is also important that we have a strong knowledge of the company and the sector that we are evaluating. How does the company make money? What are its comparative strengths and weaknesses? This is more important, if not as important. This is as important, if not more important, than building the model itself. Remember, understanding the business is much more important in valuation than anything else. So when you're building a model, you can deal with uncertainty by simply understanding the business more and more, right? Your focus while doing evaluation of a company like Infosys or TCS, or for that matter Maruti or Idea Cellular or Bharti Airtel or ITC, is first to ensure that you understand that industry very well. Once you understand the industry very well, you will be able to deal with the uncertainty. You will be much more confident dealing with that uncertainty, right? That is how you deal with the first issue that comes up while doing valuations, which is uncertainty. Let's look at the second one, which is complexity. Now, there's a common notion, especially with DCF models and any kind of financial models, that the more complex an Excel model is, the better it is, right? Now, remember, all financial models follow a principle of GIGO. GIGO stands for garbage in, garbage out, right? This is a term taken from the computer science industry. And what does this mean? That if you put in an incorrect input, it's going to throw an incorrect output, right? So if you create a very fancy model, but you're not sure of the inputs, then the moment you put in an incorrect input, it's going to give you an incorrect output, right? You are better off making a financial model more complex only if, as an analyst, you can project the additional complexity better, right? Every model will have a set of inputs. If you make more complex models, additional complexity will add to more inputs. More inputs will be more problematic because breaking higher level headers into smaller will result in more assumptions being made. More assumptions will result in more chances of error. You're not sure of those numbers. Just for the sake of making a model fancy, it doesn't mean we keep adding complexity to the model, because the more complex a model is, the higher the number of inputs into that model, and the higher the number of inputs into that model, the bigger the chances of error, right? So it is important that we understand that how complex a model should be. We very clearly define it, what is the complexity that is going to be there in the model. Now, for example, take up anything. For example, take working capital. If you break working capital down into various components such as debtors, creditors, inventory, prepaid expenses, etc., then assumptions will need to be made on each of these. Unless you are sure you can make good quality assumptions, ignore it. Right? Don't add that additional complexity. Try and work with your broader understanding of the industry. So it is important that when you break down something like working capital into individual components, most of the times this is not very difficult to do. But in some cases, for example, if I'm trying to break raw material costs down to component 1 and component 2, right? Let's say there are two inputs that go there. It is important for me to have a view on both these components. Let's say steel goes in and let's say aluminum goes in building a car. Now I need to have a view on steel, I need to have a view on aluminum if I am going to really project those two separately. Otherwise, it's just additional mathematics to the model, right? It doesn't really add any value. It probably adds to my chances of making a bigger error here. So if I am doing a raw material cost calculation, I only break into individual components if I am sure about being able to project it. So just as an example, if we take the case of something like Eicher Motors, and let's say we're doing projections on this and we look at the financial statements, and we look at what is the cost of raw materials and components consumed. That's 3423. Now let's say we're projecting this. Now what could be raw materials for a bike, right? There could be a tire, there could be wires, there could be a brake, there could be metal, there could be the rubber used elsewhere in the bike. That's 3,423 crores given in note number 23. Let's go to note number 23 to understand if we get any information there. In note 23, you basically see that they say inventory at the beginning of the year, what did they purchase, and you know what material cost they did eventually use, and that number came in here, right? They have not given the breakup of individual components. Now, if I go about finding these individual components in the form of metal, in the form of rubber, in the form of tires, in the form of wires, it is going to be a big challenge for me, because as an analyst, while I might want that level of additional complexity in the model, it just adds to my headache because I can't project those. I don't know what part of the bike is the cost of the tire or the wires or the metal, etc. Right? So unless I have that information, there is no benefit in really projecting that or trying to project that. So it is always relevant to keep the valuation or model simple, and that is true for every financial model, so as to incorporate the major features, all the major drivers, major levers of the entire valuation, but keep the complexity low. Right? Bulk of the value in a DCF or any valuation will come from basically 5-6 major parameters. It is necessary to have a strong understanding on those parameters. Other parameters will usually not impact the business significantly, right? Neither the business nor the valuation. So when you look at putting in 100 inputs into a model, remember that only about 15-20 of those will be really important for you. It is important to remember what is called as the Pareto principle, which states that 80% of the effect of anything comes from 20% of the causes. In valuation, you can rephrase that to 80% of the value of the model or the company comes from doing 20% of the things correctly. If you can project those 20% of the parameters in the model well, that is going to be the most important driver in the discussion. If you're projecting things for Infosys, you need to have an understanding on the INR USD rate. It might be uncertain, but this is some functionality that has to be built in. Why? Is because they bill in dollars and that then gets converted into Indian currency. Their clients are in the US or UK, and all the billing that is done in terms of dollars. So eventually when you're evaluating this kind of a company in India, you will have to have an understanding on INR USD. Now you may not need, and what is the biggest cost? Their biggest cost is salary cost. So maybe you want to project salary cost per person on average, but if I try to break it down into additional complexity, saying how many of them are senior employees and how many of them are junior employees, that doesn't work because I don't have that information with me, right? And so trying to project it randomly is worse than actually not projecting it at all. So we will try and understand that whenever we build a model, we don't make the model unnecessarily complex. We keep it reasonable. We put in the complexity that is required for the major parameters, but we don't go beyond that, right? So that's something that is very, very important. The next issue that you need to understand while building a model is the biases. Now, when you start building a company's valuation model, there are a lot of biases that exist in your mind while you're doing that valuation, right? The first bias starts with, if I were to ask you to do a project on this subject, the first bias that will come to your mind is what company to value. You will choose a company because either you like it, or you know about it, or you have worked here. One of these things would be driving your decision of choosing a company to value, right? Once you have decided on that, let's say I like Infosys and I start doing a valuation on Infosys, there are thousands of data points available about Infosys. What data I choose, that's a choice because I can't use everything, and that's a bias. So my bias will come very important here. Then typically, when you're doing a valuation, your valuation exercise is also swayed a lot by what is the market view of the company you're valuing today, right? So if the market view is good, if the market view is bad, that becomes important. So today, for example, a company like Infosys has a good market view. Even if you try and do a valuation and you're getting an unfavorable valuation, which is like it is overvalued, or you don't like the company for the valuation that you've done, the numbers that you see give you an indication that things are not fine. Because the market view is good, you will find it tough to put in your numbers in. That bias starts coming in into the discussion, right? What is the market price? Now let's say the market price is 1000, but my valuation gives me a value of 700. the first thought process that comes in my mind is I might be wrong, right? Now, why might I be wrong? Why can't the market be wrong? Why can the stock not be overvalued, right? So it is important for us to have confidence in our abilities. Obviously, we need to check if we have made some error, but if we believe that we have not made any error, then the market price has got nothing to do with what the actual value of the company's stock would be. Another bias that comes in is what is my perceived view or current view on a company. So, do I like a company? Like or dislike a company? For example, I do not like real estate companies in India. I think they're difficult companies, they don't run the business well, and so I don't like these companies. Now, even if tomorrow these companies do something good, my current view on the company stops me from attributing correct value to them, right? So that creates a problem in terms of biases. And then finally, the payoff and reward structures. For example, in investment banking, it is usually good to keep valuations high. Why? So there are two examples of this that you will get. Example one is in mergers and acquisitions. Deals are overpriced. Why are they overpriced? Now, 90% of the M&A is overpriced, and that's typically overpriced because the higher the price it sells at, the more the commission people helping you in the sale, which is investment bankers, are going to make in between. Typically, people end up making a fee of 1 to 2% of the deal value. So if the deal value goes up from 400 crore to 500 crore, the fee goes up from 4 crore to 5 crore. So it's in the benefit of companies to do that, right? In addition, there are biases such as when you look at analysts who write reports on equity research, more than 90%, greater than 90% of reports are reports that say buy the stock, right? Which is the stock will go up. Now that's a clear bias because most of the people believe stocks continue to go up. Out of 100 reports, 90 reports claim that stocks will go up. But stock markets have an equal probability. Not all stocks go up, right? So for all practical purposes, I shouldn't say it has an equal probability, but to be able to forecast correctly, it is not possible for me to say that in my market 90% of the stocks will go up, right? So there is something that is within the payoff structure or the biases that keeps me writing reports like this. That's because we don't like to see negative reports, right? So I keep coming out with reports which say buy the stock, buy the stock, buy the stock. It is undervalued, whereas in reality that may not be true. That's a very, very important bias, right? How do I remove these biases? To remove these biases, the first thought that should come to my mind is that I have to keep an open mind to new data. My current view of the company has got nothing to do with what new data comes in. So I may not like a real estate company, correct? But if new data suggests that these companies are doing well, I have to put this data objectively into the model. I should at least temporarily delink market prices of a stock to the valuation process. What is the current price on the stock exchange has got nothing to do with what my valuation is. So I should at least temporarily switch off, stop looking at the stock market and try and arrive at the valuation of the company, looking at what my data points are. And finally, value objectively. Your existing view of the company, maybe you dislike the company, maybe you like the company. If you like the company, you are more likely to look at positive news, right? If you dislike the company, you're more likely to look at all negative news, right? This is a bias called confirmation bias. For additional understanding, you can go and look at confirmation bias on Google. All of us seek information that confirms our current view. My current view is I like a company, so I'll look at positive news. My current view is I dislike a company, so I'll look at all the negative news. That is an incorrect way of doing valuation. I need to value all news and I need to value objectively and I need to keep an open mind, which is basically if data changes, right? Just remember these keywords. My view changes. This is a very, very important principle in valuation. Always remember, if the data changes, your view should change. Your view can change. There is nothing wrong with that. Obviously, how much the data changes will define how much your view changes. So if you're saying buy a stock, but data changes materially, significantly, you might change your view to sell, right? This data change could be in terms of some contract that the company has missed, some business order that the company has missed, or some sort of a corporate governance issue, right? That is your choice as an analyst. But it is important to value objectively and keep this in your mind, right? That's it in this particular video. Let's look at a couple of questions. Explain how uncertainty is not a problem but a friend for an analyst while doing valuation, and what biases affect valuations. Give any two examples of those.